Well, for more on the markets, we're joined by Greg Taylor, Chief Investment Officer at Purpose Investments. Thanks so much for joining us today, Greg.
Well, thanks for having me.
So I don't know where we should start first, banks or inflation, but we are seeing that comeback of those regional banks stick. And it didn't look like it for a couple of them later in the afternoon. We saw a Western Alliance actually turn negative. But what do you make about the sentiment around those banks following the failure of SVB?
Well, I think this wasn't something that was on the radar of a lot of people a few weeks ago, and suddenly came out of nowhere and spooked a lot of people last week. And as you mentioned, we got a really big sell-off in a lot of the regional banks in the last few days. So today's a bit of a relief rally. We'll see how long it lasts. But some of these names just got way too oversold. So a bit of a bounce here, but I don't think we're out of the woods yet by any stretch. There's still a lot of uncertainty. And I think this next earnings season is going to be something definitely to watch and see if there's any deterioration in the economies or some of these numbers that really put Silicon Valley Bank into issues, whether that's spread to some other banks when they report.
Would you be cautious around that sector, regional banks in the U.S. right now? What would you be thinking?
Yeah, I think you're never really looking at banks when you see an inverted yield curve. And the inverted yield curve is at the steepest decline we've had in a long time. And that's not good for the economy and definitely not good for the banking sector. So I think the banks are going to be choppy right here. They definitely got oversold, so we're seeing a bit of a bounce on relief that no other ones failed overnight, which is not the greatest reason for a bounce. But I don't think it's something you want to go fully into right now because it's still going to be a sector everyone's going to be a little more nervous about and watching closely.
What do you think the Fed does from here? I mean, we just got the latest inflation data, and it does show that it's persisting. Core inflation accelerated a bit, coming from rent, for one thing, clothing, airfares as well. But what do you make of that inflation situation and the Fed's progress so far? Well,
the Fed's in a tough situation right now because they really do want to battle inflation. That's really their mandate. And when you come out today and the CPI is still at 6%, that's not victory. Like, they've still got a big problem to deal with, and they've still, his reason is last Wednesday when Fed Chair Powell was speaking at the Congress, he was still talking about being hawkish and hiking more, and that's when the market was expecting 50. And now we had this banking crisis come out last week, and the Fed never really hikes during banking crises, so they're in a tough situation. They've got to bail out the banks on one hand, and they've got to battle inflation on the other. So probably 25 basis points next week at their meeting, but it's still going to be really data dependent, and I think that's only going to add to volatility.
What sort of reaction do you think they would get if they paused and they didn't do anything?
Well, it really depends on the reason why they're pausing. Because I don't think you can pause right now because you haven't really beaten inflation yet.
Right.
So that's not a good sign if they pause, because then you'll wonder, well, what's going on in the background that you've gotten right now? But also with the guaranteeing of all the depositors and letting some of these regional banks swap out some of their balance sheet items at par, they're expanding their balance sheet again. So we kind of are back to QE. So as much as they're trying to say they're hawkish, they're really not when they're doing this on the balance sheet side.
I mean, I guess that could be an argument for, I mean, if they are doing that, then maybe they would need to hike even more. I don't know. That doesn't.
Well, it's inflationary at the end of the day.
Exactly.
So they're saying one thing and doing the other on the other side. So they're in a tough situation, and I think they are really hoping that the economy is going to slow down on itself, and the lagged effect that we've talked about is going to kick in, but that also could push everything into recession. So this year, I think the theme is going to be volatility, and I don't think we're out of the woods by any stretch, though today is a nice relief from the last few days.
Are there any good places right now that you see to hide from that volatility?
Well, it's tough right now, but everyone's looking at cash funds. Cash funds are suddenly becoming the place that everyone wants to go to. Nice yields and short-term money market instruments, and I think a lot of investors are suddenly going back to cash funds as a hiding spot. The other area that I think could work is the real assets. Inflation's still going to be there, and if the Fed does start to slow down their pace or back off, the U.S. dollar could peak out, which is really good for the commodities, and certainly we saw gold get some life to it last few days, and gold and real assets could be something that might be a nice diversifier and a hiding spot.